the government of Kenya is proposing to sell Safaricom PLC the 15% stake at 34 shillings. Kenyans need to know that Safaricom shares were trading at an average of 45 shillings in 2021.
August 2021, Safaricom is trading at an all-time high of 45 shillings per share, around $0.35. The company is valued at a staggering 1.8 trillion Kenyan shillings, around $13.9 billion US. It is the undisputed king of the Nairobi Security Exchange, the engine of the Kenyan economy, and the crown jewel of East Africa. Fast forward 4 years to December 4th, 2025. The picture looks different. The Kenyan government announces it's selling a massive 15% stake in Safaricom, but they're not selling it at that 2021 peak. They're selling it at 34 shillings per share. At this valuation, the company is worth roughly 1.4 trillion Kenyan shillings, around $10.8 billion US. If you do the math, and trust me, every analyst in Nairobi is doing the math right now, that is a valuation drop of 400 billion Kenyan shillings, around $3 billion US from its peak. But the price tag is only half of the story. This deal is not just about cash, it's about control. By offloading these shares to Vodacom Group, a South African multinational, the Kenyan state is officially handing over the keys. Vodacom's stake rises to 55%. They now have majority control. So, we have to ask the uncomfortable question: did the government just panic sell the most valuable asset in the region at a discount to pay off debt? Did we just trade our digital sovereignty for a quick cash injection? To understand if this was a robbery or a rescue mission, we are first to look at why Kenya is broke. In economics, there is a simple rule: you don't sell your best milk cow unless you have a gun to your head. And in late 2025, the Kenyan Treasury did not just have a gun to its head, it had a cannon. By the end of the year, Kenya was facing a sovereign solvency crisis. Maturing Eurobonds, syndicated loans, and domestic debt redemptions were absorbing over 60% of the country's ordinary revenue. Think about that. For every 100 shillings the taxman collected, 60 shillings immediately disappeared just to pay interest and principal on all loans. That leaves 40 shillings for roads, hospitals, salaries, and everything else. The Treasury, led by CS John Mbadi, will tell you this sale is about unlocking value for infrastructure projects. They talk about a national infrastructure fund, but let's be real, money is fungible. The 244.5 billion Kenyan shillings, or $1.8 billion raised from this deal, is not going to build a new superhighway. It is going to plug a gaping hole in the budget deficit. It's a liquidity event, pure and simple. Now, you may ask, if we needed cash, why not sell something else? Why not the sugar millers? Why not the Kenyan Pipeline Company? Well, they tried. The government's privatization program had completely stalled. The sugar millers were tied up in legal battles. The pipeline company had balance sheet issues. Foreign investors looked at those assets and said no thanks. Safaricom was the only asset left. It was the only crown jewel with the governance standards and the liquidity to attract $1.6 billion in immediate foreign cash. The Nairobi Security Exchange could not handle a sale this big. Dumping 15% of the shares on the open market would have crushed the stock price instantly. So, the government went to the only buyer with deep pockets and a strategic interest, Vodacom. This was not a strategic industrial choice. It was a desperate move to avoid expensive domestic borrowing that was choking the private sector. We sold the cow, but we could not pay the rent. But the way they structured this sale, that is where things get creative. The government did not just hand over shares for cash. This transaction is a sophisticated piece of financial engineering with 3 moving parts. And if you want to understand who really won this deal, you have to look at the fine print. the government sold roughly 6 billion shares, that's the 15% stake, to Vodacom Kenya. They sold these at 34 shillings per share. Now hold on, at this time, the market was hovering around 28 shillings per share. So Vodacom actually paid a 21% premium over the market rate. Why would they overpay? It's called a control premium. By buying this stake, Vodacom was not just buying dividends, they were buying the right to consolidate Safaricom into their books and call the shots. Control costs extra. But then we get to part 2, and this is where things get controversial. It's called dividend securitization. The government needed more cash than the share sale could provide, so they made a side deal. Vodacom gave the government an extra upfront payment of 40 billion Kenyan shillings, around $310 million. In exchange, the government effectively said, you can keep the dividends on our remaining 20% stake until you are paid back. Based on the current dividend rates, it will take about 4 years to pay that back. That means for the next 4 years, the Kenyan government will own 20% of Safaricom on paper, but they will receive zero cash flow from it. They basically took a payday loan on their future income to survive 2025. They ate their dinner for 2026, 2027 and 2028 today. Part 3. The corporate shift. This deal also completes the South Africanization of Safaricom. Vodafone UK is stepping back and Vodacom South Africa is taking full ownership of the investment vehicle. The era of Safaricom reporting to London is over. The command center is now firmly in Midrand, South Africa. And that raises the biggest question of all. Why did the price crash in the first place? Was it manipulated to help Vodacom buy it cheap? Quick pause. If you're enjoying the video till now, please hit subscribe. And if you need a video editor for your own projects, I'm currently accepting new clients. My email is in the description. Now back to the video. When a stock drops 40% in value before a major sell, people talk. Politicians and critics have been loud, claiming the government deliberately crashed the price to hand Safaricom over to Vodacom on the cheap. They call it a giveaway. But if you look at the forensics, there was not a secret room where men in suits decided to crash the stock. There was just a perfect storm of 3 things. Factor number 1, the Fed effect. In 2021, US interest rates were near zero. Money was free, so it flowed into risky markets like Kenya. But then, the US Federal Reserve jacked up rates to over 5%. Foreign investors who own 80% of Safaricom's tradable shares did not just walk away, they ran. They sold everything to move their cash back to safe US Treasury bonds. Factor number 2, the dollar trap. Between 2022 and 2024, Kenya ran out of dollars. Major foreign investors like Fidelity tried to take dividends home but could not. Their money was trapped. Frustrated, they dumped millions of shares, driving the price down to lows of 11 shillings per share. At one point, the market was not manipulating the price, the market was panicking. Factor number 3, the Ethiopian discount. We all celebrated when Safaricom entered Ethiopia, but expansion is expensive. The Ethiopian unit has been bleeding money over 20 billion shillings a year in startup losses. Plus, the Ethiopian currency crashed, and hyperinflation accounting made Safaricom's profit look erratic. Investors hate uncertainty, so they punished the stock. So, was the government manipulating the price? No, but they're not innocent. Absolutely not. They did not rig the stock market, but their mismanagement of the economy, the dollar shortages, the debt, created the environment that killed the share price. They're not guilty of conspiracy, they're guilty of incompetence. If you look at the balance sheet today, Safaricom Ethiopia looks like a disaster. It is currently in what venture capitalists call the valley of death. The Ethiopian unit is burning through cash, reporting losses exceeding 20 billion shillings, around $154 million a year. They are spending billions building 3,000 towers and fighting for every customer. And to make matters worse, when the Ethiopian government decided to float their currency in 2024, the value of Safaricom assets there took a massive hit overnight. So, why is Vodacom fighting to pay a premium for a company that is bleeding money in a war zone? Because Vodacom is not looking at 2025, they are looking at 2030. In just a few years, Safaricom Ethiopia has already signed up over 10 million active users. Ethiopia has a population of 120 million people. It is one of the last great uncaptured markets in the world. This is the classic J-curve. You lose money for 5 years, so you can print money for the next 50. The currency crash was painful, but it was necessary. It means Safaricom can finally take its profits out of Ethiopia. Vodacom knows that the Kenyan market is mature. Everyone here already has a phone, but Ethiopia, this is the new frontier. By taking majority control now, Vodacom ensures that when the Ethiopian Valley of Death turns into a mountain of cash in 2028, the dividends flow to South Africa, not the Kenyan treasury. For 20 years, the relationship between the Kenyan government and foreign investors was a partnership of peers. With a 35% stake, the government had a veto. Major decisions required censors. We were in the room where it happened. That era is over. With 55% ownership, Vodacom can now unilaterally pass ordinary resolution. They can appoint directors, approve financial statements. Now, the government did manage to negotiate one failsafe. The shareholders' agreement explicitly states that the CEO and the chairman of the board must remain Kenyan citizens. It is a nationalist firewall designed to make sure the face of the company remains local. But let's be honest, that is soft power. The CEO might be Kenyan, but if the majority shareholder in South Africa wants to cut dividends or pivot the strategy, the CEO has to fall in line. The hard power of capital allocation has moved from Nairobi to Midrand. And this matters because Safaricom is not just a phone company. We saved the budget, but the M-Pesa miracle is no longer fully ours.